What's up, everybody? Welcome to the Intelligent Investment Show Live. I am Garrett Lill from the Wealth Partners YouTube channel with the legend of Las Vegas, Matt Dahl. Good to see you, brother. How are you today?
I'm doing great. How are you?
I am doing well. Well, actually, can we be honest on this show? I feel like we can be honest on this show. I am not having a great day. I have woken up as I was getting ready this morning. My daughter screams at me that the toilet is overflowing. Now, not in the way that you would think. It's the toilet tank on the back of the toilet had overflowed somehow or another.
Okay.
So that I'm glad that she told me, because in the amount of time that this had happened, it had already like completely flooded half the bathroom. So I used up almost every towel that I had, trying to just stop the bleeding there, get them off to school, come back, get everything kind of squared away, get that fixed. And then I could sit down at the table here and we don't know this necessarily because I've got the virtual background up, but this show is recorded live and in color from my kitchen table. So as I sit down, my 5-year-old had left a cup of water sitting on the table, and I accidentally bumped it with my hand or my computer or something as I was sitting down. So that's toppled another load of water into the floor, and I didn't have any towels to dry it up with because all my towels were already spoken for in the bathroom. So it has been a flood of problems today. How's that?
You know what? That's a great segue into it. Actually rained in Vegas yesterday for the first time in a long time.
I didn't know that it did. I didn't know they did that. I didn't know that was
It,
even possible.
I saw it once and I was like 9. And that's what they. And that's I went into the books last night. I had an old encyclopedia. I was like, "What is this? Why is there water falling from the sky? Is there a
What is
leak up
this
there?
water
Something
stuff?
called rain."
Yeah. Huh.
And it's
Go
pretty cool.
figure.
It
How
was
about
really
that?
nice. It was really nice. Like, this is kind of pleasant, you know.
Something a little different. Yeah.
Yeah.
Nice. Well, so what's going? So you were a little bit spoken for the last week or so. It sounds like, with your daughter's wedding, a lot going on. Are things getting settled back in? Have you had a chance to really get back in the swing of things? We're having a little bit of an off day on the market right now. 1:10 Eastern time, 10:10 Pacific. We're down about 2% at this moment. So what's going on out there?
Well, the old the old the old tariff talk came roaring back today, which was
Hmm.
always fun. Yeah, so my daughter, she got married last Saturday. It was a beautiful ceremony. It couldn't have gone on any, it couldn't have got off any nicer. Everyone did a great job, but it's been like a full-time job for the entire family putting it on and make sure it's perfect, right? So I'm getting back into the swing of things now, which is good. Nice as fourth quarter as I really start diving into the research for next year, looking at the macros, looking at from the top down, looking from the bottom up, seeing what sectors we like, seeing what the interest rate environment will look like, seeing which companies inside each one of those winning sectors is the superstar, trying to stay away from the losers. All of those things usually takes me a few months to sort of put together. So how I've always done it is, and it's not a good way or a bad way, it's just my way, is I think we're people, what game do we play, and how is the score kept? Okay. Well, it's our job to make people money. Okay. That's the game that we play. Okay. And the score is kept every year. Okay. Not so much every quarter, not so much every month, but it is kept on an annual basis. How did you do for me last year? The S&P did this, the Dow did that, whatever. How did my investments do against the market? And so that's what I try to do, is build these portfolios now for the following year. And I usually put them in place directly after the anniversary of the previous year. So any positions that I sell that have large gains in them, that I'm going to divest and replace with a different position, is treated at long-term capital gain status instead of short-term capital gain status. So it's kind of there's a science to it, there's an art to it, like everything else, and that process typically begins in earnest on October 1st. There's always research going on all the time. That never stops. Okay. But as far as we really start drilling down on, for instance, the wedding, right? We're going to have a wedding. We're going to have guests. And we think we're going to have these people and those people and these tables and that tables. Well, you get closer to the wedding, we know exactly who's coming and exactly what tables they're going to sit at, right? That's what we're getting into now for next year. And I usually update the portfolios typically in January, February of the following year. And here's the thing: is between now and then things change. So I kind of have some time to watch things evolve, because these ideas, these thoughts, and the thesis itself, it starts, but it morphs, it evolves as the months go on, and it usually paints a fairly clear picture, But I just need time to do it. So, yeah, we're having a good day today. I mean, sorry, a good sell off today is what I meant to say. A nice healthy sell off. The Dow
A
is
good
only
day
down
if you're looking for a discount, right?
It's a good day if you're short the market.
There you
It's
go.
a great day if you're
It's a
short
good day
the
for
Nasdaq.
somebody.
Yeah, exactly. It's a good day for someone. But you know what? The market needed this. The market needed this. So we've been, I mean, the Nasdaq's down 600, down 2.6%, right? It's at 22, whatever, it's right about 22,000, 22.4. So it went, over 23,000. We stopped allocating new dollars in at 21,000. Okay. We're certainly not going to short the market. That's not who we are. We don't do those things. We don't sell out. We never go bearish. We never go bearish. I'm not bearish at all. We have stronger, we've made the case why we think this is a long-term bull market, and we are dead in the middle of it. In fact, today, I believe it's 3-year birthday. The bull market turned 3 today. But there's also a school of thought that a new bull market started in April, which I can understand too. So that being said, I think I think the market did need to pull back a little bit. It didn't get over exuberant. Okay. In fact, yesterday when it was released, the AAII Bull Bear Sentiment Survey came out, and it's the highest it's been since January. And we're only 10% net bears. We're basically 10% net bulls. We're only 45% net bulls, 45% bulls, 35% bears, 20% neutral. So we're not over exuberant here. Typically, what I look at for a buy signal or a sell signal, if I'm going to do something like that, like the market is way overextended, is a 25 to 30% spread, right? And that's usually works as a buy signal when you have bearish sentiment over 50 and you have bullish sentiment under 20, right? That's usually a great buy signal. So, we never really got overextended. We never saw bulls get into the 50s or high 50s, anywhere near there. We haven't seen bears get anywhere in the 20s yet. So we never got overextended on for sentiment. And I think if you look at some of the sentiment data that's come out on a macro side, it makes sense. Now, again, we've railed against sentiment data versus hard data in the past, right? So UMISH consumer sentiment survey came out today as well. Came in at 55.1, up from 55.0, last month. But those numbers in 2019, things in those times they were over 100, 101, right? So we like those numbers to be 85, 90. They haven't been ever since kind of COVID crashed down. We really haven't seen anything. It got as high as I think 80 last year, or 67 last year. We got as high as 61 in July this year. The depths of April and May got to 52.2 in April and May, and we're only at 55 now. So we don't have a tremendous amount of consumers, confidence out there. It was a UMIS consumer confidence survey. So, and if you look at the sentiment data on the market side, we're seeing the same thing. We're only seeing, a 10% net bull spread. So people aren't overly bullish about this market, which leads me to believe that this pullback is not going to be the big wild one we all think it is, unless the tariff talk gets ratcheted up and it actually spreads into potentially other regions, potentially Japan, Canada, Eurozone, anything. I don't expect that's going to happen. This seems to be an isolated incident involving the rare earth exports that are being controlled, are going to be effectively restricted now to the United States.
So you mentioned in the beginning of that little segment there, the heading into this time of year, looking at taxes and what, given the choice, we would prefer to book long-term capital gains as opposed to short-term. However, there's also a tail wagging the dog that can play itself out there sometimes, where if you hold a position too long to try to, if you hold a position for an extra 2 months so that you can save a little bit on the taxes, and then that position ends up going down in value 25%, then you negated the tax savings anyway. How do you, when you're managing the portfolios, balance those two at this time of year? Because there's a lot of that, not to say that you're not always rebalancing in January. So there are going to be some positions that you put on last July that you might be facing that question in June. There might be times that, you are doing some rebalancing around the first of the year. So you're looking at it, at this point. But how much do you factor that in, and how do you just balance that out? Because I mean, there's always the risk of letting as I said, the tail wagging the dog there. So how do you make those decisions?
Well, a lot of it has to do with the general time frame I'm trying to keep I'm trying to hold the positions for. Okay. So in theory, okay, now Yogi Berra says about theory, right?
There you go.
What was it? In theory, practice isn't all that important, but in practice, whatever, I can't remember how he said it. But theory is theory. In theory, we want to hold all these positions for infinitum, right? In perpetuity. Right. So we're not ever trying okay, it's been 1 year, it's time to sell everything and bring new stuff in. That's not how it is. We build these portfolios for the longest term possible. So in situations where we start to look at a deteriorating position, okay, and I can look at it both on a fundamental. We see maybe earnings revisions are lower. It's an interest rate sensitive sector, and maybe interest rates aren't playing ball with us. And again, investment is a discipline of relative selection. So we don't have to hold that if there's other positions that are available. I mean, we can simply say, okay, well, there's these other positions that are already in the portfolio are doing quite well and continuing to do quite well and are accelerating. Okay, we just remove this and kind of rebalance the rest of the stuff around it. We can do that too. So yeah, there's no hard, fast, rules for, well, I'm holding this position no matter what until this day. Okay, I built this portfolio to work in perpetuity, and of course, it's never going to do that. Really, really good is not the enemy of perfect. I looked at our focus portfolio today. It's our all equity portfolio. Okay, it's not our super aggressive one, but it's all equity. It's our kind of our blue chip, kind of leaning growthy portfolio. It's what we benchmark against the S&P 500. Okay, and we're happy to say, as of close of market last night, it doubled. We're doubling the market again this year. So with that portfolio, so that's the idea. But you can't. So if we're building those positions in the beginning of the year, trying to really outperform the market, and we start to see a couple bad actors in there go the wrong way on us, well then we have to deal with those pretty quick, because we don't typically, if we're going to overweight a position like an Nvidia, like a Google, like a Microsoft, something like that, which are more what we consider core positions, that I don't look at those things on a really a weekly basis as far as any sort of deterioration, because I'm looking at Nvidia as being a revolutionary, game-changing company that is going to probably be the cornerstone of our portfolios for probably at least 5 years. So whatever happens between now and then, I'm okay with. Same thing with Google. Same thing with your Amazons, your Apples, your Microsofts, your Costcos, your Visas. We have some core positions we know are fundamental to the zeitgeist of the American economy now, if that makes sense. Okay, and if you look at a very long-term chart of these companies, it's up and to the right. So I'm not too worried about that. It's more of the what we call the satellite positions that I really focus in on and say, okay, well, like for instance, one of the positions in the portfolio is Sterling Infrastructure. So a small cap position, we took it about 135. I believe it's 365. Okay, and we took that in January. It looks phenomenal. If we start to see that deteriorate, okay, well now I'm in a massive gain, a huge gain. So you look at a gain like that, well, we've effectively tripled it this year. Okay. Well, that thing has to go, if we sell that now, especially with some of our clients or the ultra high net worth clients that are in higher tax brackets, okay, we sell that position on an income rate, that's a big, ugly day for them. So but if we wait until it's a long-term gain, it changes that math considerably. Now, that same position, let's say it's only up 9% this year. Maybe it's up with the market. It's up 13.5% year to date or 14% year to date. Well, that's a different story. Okay. If we sell that 14% gain, okay, now versus selling, basically having it flat next year. So obviously which version has a net present value greater than zero? And the whole thing is it's an exercise. It's a guesstimate, right? Where do I think that position is going to be February 13th of next year? No one knows. I have no idea. So we have to look at that and look at the general trajectory, look at where the earnings are going, where the sector is going, and then make that call.
Yeah, and kind of, second cousin to that question. I mean, they're related, not closely related, but somewhat closely related. When you're putting together a portfolio, I mean, you have a game plan, you have a strategy, you have an approach, you have whatever you want to call it. I was very, almost to keep myself from getting too complicated and too overly analytical, I would create like a systemized form of building the portfolios. If it's going to be this and it's going to be this, I'm going to pick 25 stocks based on this criteria, whatever, and I'm going to rebalance it quarterly or whatever. And then as I would periodically, go back and look at my spreadsheet or look at my data or wherever, I've got 25 stocks, and the 25 that I selected last quarter are no longer the top 25. If number 18 in July is now ranked 127th, then I'm going to make that change. That's an easy call. If number 24 has now dropped to 26, probably not going to make that change. It's probably not worth the trouble, the risk, whatever, to pick a stock that is 1 decimal point better on my proprietary formula that I've created that is probably totally useless, but that's how I'm doing it. So when you're going through whatever your system is, whatever your process is, how do you draw the line in the sand to say, okay, if a apples to apples comparison, company A is trading at 17 times earnings with a projected growth rate of 48%, and company B is trading at 19 times earnings with a projected growth rate of 58%, that's like splitting hairs almost. On the other hand, 20x versus 40x, with the 20x at a 35% growth rate and the 40x multiple at a 2% growth rate, that's an easier call. So how do you try to figure out where that line is between, okay, this is a big enough change that's worth making, and this may be a change that's not, the juice isn't worth the squeeze?
Well, so where are we at on the track, right? So if I think we're starting to roll over, well, then it's probably a good time to make that move. If I'm looking, for instance, like, again, there's this whole talk now about this AI bubble. It's been all week long. Are we in a bubble? Is AI in a bubble? Bubble. This is 2000. This is 1999 all over again. It's 2000. It is not 1999 all over again. It's not 2000. I'm guessing the producers at these financial networks are getting, they're just looking for things to talk about, and they're just
fear sales, man. Fear sales. Yep.
So they're trying to create a subject matter that's interesting that can sell advertising time, because we're not in a bubble. Okay. Costco, 46. Here's, and this is to your question. Costco, 46.5 times earnings with an 8.3% projected growth rate. You're talking about a 5.6 times PEG. That's pretty high.
That's pretty
Walmart, 36 times earnings with a 7% projected growth rate. You're talking 5.1 PEG ratio. So are they in a bubble? Those are consumer staples. Those are bread and butter consumer staple companies. Walmart, Costco. Okay, well, Nvidia growth, AI bubble, blah. It's the cheapest of all of them at 33.1 times. Okay, with a projected growth rate of, which I know it's a low projection of 18%. It's probably going to be closer to 30. Okay, so does that mean Walmart's in a bubble? Does that mean Costco's in a bubble? No, of course not. So when you start looking at, as these companies deteriorate, why are they deteriorating? Are they just not growing into their earnings fast enough? And are they flattening out, or are they actually deteriorating, or have they deteriorated already? And then back to where are we at on the track? I think we talked about this last time. A client brought his portfolio in, and he had a big position in Tesla. It was like 40% of the portfolio. I was like, man, this is way too overweighted. We need to, get rid of this. I'm not a Tesla person. Tesla's a wonderful company with great products, but their stock is difficult to make sense of for me. It just is. It always has been. It's a trading stock. I get it. But for me, it's just been one of those stocks where, it's been overvalued. It's a car company. It's a tech company. There's a lot of debate that swirls, and that's okay. I was, oh, no. This was last November when it was about $430 a share when it came in. And he didn't want to sell it. He thought it was going to 600. I said, I don't think so. Well, of course, it deteriorated all the way down to 2 something, 290, 270. And when we spoke with him about it, he goes, yeah, sell it. Just because you're right. No, I'm sorry. He called us several months ago and said, you guys were right. We should have sold it. We shouldn't have kept it. Sell it. Well, now it's at $300 a share. It's not at $420 a share. I said, no. We're on the other side now. Okay?
Well, and unfortunately too,
we're now at the beginning of the track. We're launching the car, right?
Yeah.
We're letting the clutch go and the wheels are up. And we're taking off now. Okay.
Well, and unfortunately too,
we were at the end of the track. The parachute was coming out. See what I'm saying?
Yeah, and it's funny too because at $400 a share, at 40% of the portfolio, you've got a really overvalued stock that's taking up a really big piece of the pie. Once it drops to 250, you've got a pretty fairly valued stock taking up 25% of the portfolio. Now all of a sudden, problem solved, right?
Exactly. So he's like, so we should sell it. I go, no. Now's a good time to buy it. No, we're going to hold it. He said, what do you want to sell? I said, I'm going to sell this thing at 4. If it gets to 430, I'm selling it at 430. And I sold it at 432. Okay. Nice. And it went to 450 or 460. I think it's down below about 430 right now, whatever it is. Okay. Yeah. But it's when you're selling something, are you selling it at the top or are you selling it at the bottom? Sometimes you wait too long. And here's the thing is, as good as we all like to think that we are, sometimes I stay at the party too long, or sometimes I show up and honestly, I would say my biggest sort of thing, my thing that I need to work on is I tend to show up to the party a little early. Okay. Like for instance, a good one is small caps. Okay. I've been in small caps now for well over a year. Okay. Thinking it was going to take off about this time last year. Well, I was about 10 months early to that party. Okay. There's nothing wrong with being early. You just got to kind of sit and drink in the corner alone for a while until everyone else gets there. But they got there. They showed up late in the summer. Like, what's up, dude? How long you been here? I'm like, oh, I just got here too. I just showed up. Like, I'm surprised I got here ahead of you.
Yeah, it's that's an interesting self-assessment, and I think it's something we all need to do is assess our tendencies and make sure that we're guarding for them sometimes, I guess. But yeah, we've all had those those clients and investors too have had those positions that you just can't let go of them when you need to let go of them, and then by the time you decide to let go of them, it's too late. And I've had a lot of those conversations with folks that have I've been telling them to sell something. I had this thing going on with a guy when Twitter first came out, and it was like 60 a share. And I mean, he wanted to put everything he had in it. And I'm like yelling him against it until it finally got down to 15. And then at 15, I'm like, actually, now you should buy it. Now it's not such a bad, it's pretty good buy now. But anyway, that can be.
Well, right. But I mean, especially in our world, if you're not willing to be introspective and say, because listen, as good as I would love to think that I am and our firm is, and I think we do the best job that can be done. Okay. That doesn't mean we can't be better. Sure. That doesn't mean we can't learn from not necessarily mistakes, but maybe again, being a little early or being a little late. And why were we early? What factors made quantitative factors that I can measure that showed me I was early? What factors that I can measure, quantitative factors through technical, through DeMarc, whatever, that show me I was late. And then I can, and every year, every month, every year, I can narrow down and try to become better every month, every quarter, every year. Because that's what we're paid to do, to be the best we can be.
Yeah. So what we got going on in the market next week? Anything? We're not. When does earnings season really get fired up?
Earnings is just beginning this week. We got Pepsi, I think Delta Airlines this week. But next week, I mean, starting not next week, but the week after is when we start getting into the big tech earnings, and that's when things are really going to take off. Last quarter, S&P was 66.52 a share. This quarter projected at 67.06 a share. We'll probably get to $68 a share. 68, I would say 68.15. Next quarter, there's a nice little jump to 69.67. And that's when we're starting. And that's, remember the beginning of the year or in the early spring, we said, earnings revisions are starting to tick up, and they've really started to tick up. We've got 2026 earnings now at 304 a share. We've got 2027 earnings now at 344 a share. I mean, those were 298 a share and 334 a share respectively. Okay. So we're starting to see some of those earnings revisions now on this year start to kind of accelerate away. I mean, if you're looking at Q2 earnings, 66.52 versus Q4 earnings being 69.67, you're looking at, about a 5% increase in earnings, quarter over quarter, over 2 quarters. That's pretty solid. That's what justifies the 22.5, 23 times multiple on the S&P, because a lot of that's coming from that tech side, that AI side, and that AI side it's causing a problem, but it's also its own solution, right? Market-wise, I would say. I think some of the issues in the labor market are related to AI. I think lots of folks, lots of companies, they're looking now through the natural attrition of employment, people retire, people quit, they find another job, they want to go home, spend time with their kids. For whatever reason, they're leaving these companies. Okay. Leadership now is looking at how can I replace these 10 people with 4 people and an AI system that costs me, by the time it's all said and done, half as much. So, and we've talked about this before, we're not really seeing layoffs or anything like that. We're not seeing really firing people. Companies aren't really laying people off yet, but they're not rehiring people. So we're in this no fire, no hire situation. And AI is part of that. But the other thing that how that helps market-wise is and that's where I think we're seeing these earnings revisions tick up, is the margin expansion. We're getting margin expansion from these systems because labor is obviously the biggest cost of any employer, right? So if you can lower that cost a little bit and get frankly the same or better productivity out of it, that's ideal. So I think we're sort of in this transition now, and I think this transition is going to last. I think we're in the nascent stages of it, and this could last for, I don't know, 5-10 years. It's anyone's guess, but I would say the next 24 to 36 months are going to be the indigestion part of this, as AI starts to infiltrate and replace systems, and that works itself out. So I think the labor market is going to be tricky to ascertain, even with rate cuts. Even with rate cuts to spur economic growth, to remove that restriction, that monetary restriction, we might not get the acceleration in the labor force that we're expecting to see, and a lot of that might be attributable to AI. And I think that could cause some issues in the economy, and this is where we'll probably get a bifurcation in economic data versus market data, where the market will actually like it, but the economy won't. But again, you can't separate them too far, because if we have earnings expansion or margin expansion and earnings going up, that's great. But those companies, whatever they're doing, whatever their product they're selling, whatever goods they provide, they're providing it to humans. They're not providing it to robots. And if there's not enough people who go to work to pay for whatever services and products they're providing, it'll eat itself. So it's going to be an interesting development to watch.
Yeah, that would be a really juicy topic maybe to have a conversation on next week, because I think we've seen we've seen the segment of the game where AI starts to make our lives really cool and make some things a lot easier, but we've probably not gotten to the part where it really starts to have a structural change on the way companies do business, in the sense that you're talking about. And I hadn't really thought about it that far out to say, okay, yeah, you're right. Robots, we're not selling products to robots. So even though robots might be able to do perform the task easier or more cost effectively than a human, at some point, you're right, it starts to put a damper on the economy, and we have to figure out, what that means going forward. So we can probably talk about that for 30 minutes next week. I'd be interested to dive into that more. But for this week, if you are enjoying the show and would like to chat with Matt and his team, you can visit intelligentinvestment.com to learn more about ARPG and Matt and his brilliant team there, or give them a call at 702-655-8300. I remembered it this time. I had like a mental block last week, couldn't remember your phone number. But anyway, I appreciate your time. Honey. Yeah, too much hot honey. So you did finally get to try that. We talked about that last week, though. You did.
It was good.
Right.
It was good. It was good. It had a kick.
Really solid stuff.
It had a kick.
Awesome, man. Well, enjoy your weekend, and we'll see you next time. For the listeners, viewers, stick around for the really fun disclosures that I have to play here. And Matt, you are free to go. I'll see you next week.
See you next week, bud.
See you, man. Bye.
Discussions in the Intelligent Investment Show are for educational purposes only. The information presented should not be considered specific investment advice or a recommendation to take any particular course of action. Always consult with a financial professional regarding your personal situation before making investment or financial decisions. The views and opinions expressed are based on current economic and market conditions and are subject to change. There is no guarantee that any statements of future expectations will come to fruition. All investing involves risk, including the potential for loss of principal. Securities offered through United Planners Financial Services, member FINRA, SIPC. Advisory services offered through American Retirement Planning Group. ARPG and United Planners are independent companies. Garrett Lill and Wealth Partners are not affiliated with ARPG or United Planners. Any endorsement that I may have given during this recording, it is important to note that I am not a client of ARPG. The views expressed should not be considered representative in any way of my past, present, or future experience with Matt or ARPG. No incentives have been provided to me in connection with any endorsements I may have given on the Intelligent Investment Show. Investing involves risks, and there is no guarantee of any future results